Just to explain the buyback, I'll start from the beginning. Remember, we're gonna have a company, okay? And on top of having a company, we will have the shareholder, but we will only have the shareholder if the shareholder simply buys shares from the company. In this case, let's say the shareholder buys 10,000 shares from the company. In return of owning those 10,000 shares from the company, the shareholder will receive what we call a share certificate. Now, for this transaction to happen, the shareholder must pay an amount of money to the company, and the company will recognize that amount of money as share capital, meaning that those 10,000 shares were actually issued only at 2 cents, meaning that the company will have a share capital of 200 Rand. This is how money moved. When we talk about buying back the shares, now, when you rewind, you can actually rewind to see what happened. It's just a reversal of what I've just explained. Buying back the shares simply means that you have a company and a shareholder already exists, but the shareholder is actually retaining. So the company is buying back those shares. So those shares are going back to the company. And on top of that, the company must also return the 200 Rand that it received from the shareholder as it is. But obviously, the company in most cases will pay for the shares at market price as at that date the buyback took place. However, please note that the share capital note or your share capital will decrease by at the original amount of the shares that was received. In this case, it should, in a perfect world, decrease by 200 Rand when those shares are bought back. But because, guys, we have bought so many shares throughout the year, it's hard for us to find out what each share cost. Therefore, we're going to approximate the original value of each share by using what we call the average price per share. I normally refer to as APPS, which stands for average price per share. That is the close estimate of the original amount of the price of shares that we initially issued. In this case, note that we are buying back those shares. And when we buy back those shares, our share capital will decrease by the original amount, the original issue price. But because we have issued so many shares throughout the year, it will be difficult for us to get the original price of each share. That's why we will use what we call average price per share. All right. That's what the buyback is all about. I was just giving you guys a full picture of what the buyback is about. Okay, now a share buyback is when the company buys back shares it previously issued. The company will have to pay for those shares and it will result in the cash outflow for the company, money going out. At the end, the company will have its shares back and the shareholder will have their money back. It simply means that the company, it means that for the company to buy back shares, it must have enough cash. So the company cannot buy back shares unless it has enough cash. Okay. Only willing shareholders will be interested to sell their shares back to the company. And here are the reasons for the buyback. The company may have a lot of unutilized retained income and may want to reward its shareholders. Retained income is simply all your unused profits. So you will simply take those unused profits and reward your shareholders by giving them the money they invested in the business. So you're paying them back. That's why we simply call it as though it's a reward to the shareholders for their vested interest in the business. If the company feels that the shares have been undervalued, it will buy back its shares. What the buyback does is that it increases the value of shares because you're sending a positive signal to the market that you have enough cash. And you have enough cash to the extent that you don't know what to do with it except to reward your shareholders, to return it to the shareholders. And that will actually increase the value of your shares. And remember, when you decide to sell those shares at a later stage, you will sell them at a price higher than the buyback price. So basically, you're forcing your share price to go up. Okay. And another reason will be to increase the holding interest of shareholders who decided not to sell shares. So note that if one shareholder decides to sell their shares, it means that there will be a small number of shareholders that share in the interest of the company, meaning that each shareholder that is remaining will get a bigger cut of the cake, all right? Now, the shareholder has died and his heir is not, does not want to be a shareholder in the future. Now, in this case, it simply means that sometimes if you are a shareholder, you'll have a heir who will inherit everything that you have, and including the shares that you own in certain companies. Now, if your heir doesn't want to be part of the company, they will sell those shares back to the same company, and that's why some companies will have to buy back those shares. And please note that if the share buyback was a forced sale, the company didn't want to buy back the shares, they have an upper hand of buying back those shares at the lesser amount, at an amount way lesser than what the market is providing at that moment. Another reason there will be a buyback is when the shareholders are desperate to sell their shares because the company is continuously making losses, or the business is about to close down and wants to return money to its shareholders. And you need to understand that when the company closes down, the shareholders will only receive what is remaining after the business has paid its lenders and SARS. Another reason is if the company intends to reduce the amount paid out as dividends. Remember, the more shares are issued, the higher the amount of dividends you need to pay. So to lessen that burden, what you will simply do is to buy back the shares. The lesser shares in issue, the lesser dividends you have to pay out. And when the company wants to get rid of a shareholder because of incompetence, meaning that the shareholder does not act in an appropriate manner or what is expected of the shareholder, in that case, the company might have to buy back its own shares. Or when the entity wants to boost its financial ratios like earnings per share. Remember, when you calculate earnings per share, you simply take your net profit after tax is divided by the number of shares issued. So the lesser the shares issued, it means that your earnings per share will be higher in a fraction. If the numerator remains constant and the denominator becomes small, the whole fraction will get bigger and bigger and bigger. And the higher earnings per share, that is good because it tells shareholders that the company is doing well and other stakeholders, obviously. And it will also increase your net asset value. Now, these are the financial indicators that must be met before and after the buyback. The first one will be solvency and liquidity ratio. Solvency relates to the company's ability to settle long-term debts, so the company must be able to settle its long-term debts before and after the buyback. And liquidity refers to the company's ability to settle short-term debts. So the company must be able to pay its short-term liabilities before and after the buyback. So long-term and short-term liabilities must be paid before and after the buyback, all right? Now, this means the company must have enough cash and retained income to buy back the shares. Using the loan is not a good idea because remember, a loan attracts, you need to pay it back with interest. And you're also not sending a positive signal to the market because you're simply saying that I'm buying back the shares, but I actually don't have money to buy back the shares. So that might backfire. And it might also weaken your solvency or liquidity ratio because that will affect your ability to pay them off. So when you take more debts, the ability to pay the debt off will be affected. Therefore, the first condition might not be met if you decide to use a loan. And note that the Companies Act only wants condition one to be met, which is your solvency and liquidity ratio to be met. Now, what is the average price per share? I spoke about it earlier on. The average price per share is simply a good estimate of the original cost price of the shares. Remember, the cost price is simply what it cost the shareholder to buy those shares for us to have capital. Because we have issued so many shares throughout the years, it will be difficult for us to trace how much each share was costing. And according to mathematics, the median, and not the median, the mean is considered to be a precise measure of precise or an accurate estimate when we don't know the actual amount. That is why we simply find in the average. I normally refer to it as APPS, which is the average price per share. Now, please note that when we buy back the shares, those shares might be bought back at a higher amount, an amount higher than APPS. If we buy them at an amount higher than APPS, know that we might, not actually we might, we will incur a loss, because it means that we're giving the shareholders, we're retaining money to the shareholders, but more than what we got from them. Therefore, we as the business are losing. How do we calculate the average price per share? You will take your share capital before the buyback and divide it by the number of shares issued before the buyback. So everything here happens before the buyback. All right. Let's look at how we can incur profit or make a loss due to the buyback. If your average price per share is less than the buyback price, note that the buyback price is the amount the company has paid for the shares when it buys it back. So if your average price per share is greater than your buyback price, you will make a profit. So meaning that the company is returning to the shareholders an amount less than what it initially received from the shareholders. If the company returns more than what it actually received, then it will make a loss. Okay, so we pay more than what we actually received. Remember that APPS refers to the amount we actually received, we initially received by issuing shares. Okay, I just need you to write notes on this and make sure that you understand the theory behind this before we can start with the example. So we'll be doing this example in the next video. Read those notes and fill in the missing words as per the handout, and make sure that you understand what I've explained there, because now I'm going to be putting it into practice.